Uber. It's no longer just a ride-hailing app, it's a global force in transportation, food delivery, and even logistics. Whether it's ride-sharing, scooters, Uber Eats, or its growing freight business, Uber operates in over 70 countries, constantly finding new ways to move people and goods. And they're not stopping there. The company is diving into self-driving tech, advertising, and financial partnership products to keep the revenue coming. Now let's switch gears to Lyft. Lyft is all about getting people from point A to point B, but it's not just about rideshare. Lyft also offers bikes, scooters, and even car rentals through its Express Drive program. It focuses mainly on the US and Canada. Like Uber, it's involved with electric vehicles and autonomous driving. Both companies are in the ride-sharing game, but their size difference is like comparing a city bus to a scooter. Uber has $155 billion in market cap and over 31,000 employees, while Lyft, with $5 billion in the market cap and fewer than 3,000 employees. Same industry, very different scale. When it comes to stock performance, these two are telling very different stories. Over the last 3 years, Uber has skyrocketed 120%, while Lyft has plunged 67%. Even in the past year, Uber is over 24% year to date, while Lyft is still struggling in the red. If you had put $1,000 into Uber 3 years ago, you'd be sitting on $2,200 today. But if you had bet on Lyft, that same $1,000 would now be worth just $330. Uber trades at a premium, reflecting investor confidence in its growth and profitability. While Lyft appears cheaper based on some valuation multiples, the key question is whether it can turn things around. With Uber's strong revenue multiples and steady expansion, most investors seem to be betting on its long-term dominance. When it comes to profitability, Uber has the edge. Sure, Lyft has a slightly higher gross profit margin, 35%, versus Uber at 33%, but Uber pulls ahead where it really counts. Uber's EBIT margin is 6%, while Lyft's is in the red at a negative 1.9%. That means Uber is actually turning revenue into operating profit, while Lyft is still struggling. And it doesn't stop there. Uber's EBITDA margin is 8% versus Lyft just a half of 1%, and its net income margin is 22% compared to Lyft's 0.39%. Plus, Uber generates way more cash from operations, $7.14 billion versus Lyft's at $849 million. Bottom line, Uber's business model is stronger and more sustainable. Lyft actually leads in short-term revenue growth, up 31% year-over-year compared to Uber's 17.9%. But when you zoom out, Uber is in the long-term winner with a 3-year compounded annual growth rate of 36% and a 5-year compounded annual growth rate of 27%, compared to Lyft's, that's 21.7% on a 3-year compounded annual growth rate and 9% on a 5-year compounded annual growth rate. And when it comes to levered free cash flow, that's cash left after covering financial obligations, Uber is up 225% over 3 years, compared to Lyft's 32%. Simply put, Uber has a much stronger ability to generate and keep cash. Insider ownership. These are shares held by company executives. Is higher at Lyft at 4.7% than Uber at 0.16%, suggesting Lyft's leadership has more skin in the game. Bottom line, Uber's got the size, the profits, and the steady growth to stay on top in ride-sharing. Lyft, meanwhile, is struggling to turn a solid profit and keep up the long term. Investors seem to be betting big on Uber's growth, while Lyft's lower price to tempt those looking for a turnaround. But for now, Uber is in the driver's seat.